Hello everyone and welcome back to today's video. Today we are going to be talking about the most common mistake that new traders do. Now, we're all human, we all make mistakes, but I have noticed that a lot of new traders are actually doing these mistakes over and over again. So today we're going to go through the most common ones. So the first one is going against the trend. Yes, you heard me say it before and I'm going to say it again. A lot of new traders are afraid to buy in an uptrend. Why? I don't get it. Or sell in a downtrend. They always try to pick tops and bottoms that are going against the trend, which basically doesn't make sense because it affects your risk ratio. If you go with the trend, always remember this rule: the trend is your friend. The trend is your friend. Now, let's look at this example right here of the Euro USD. Notice lately how the Euro USD is having a downtrend. Now, this is our trend here. So people are always trying to buy in these areas like here, like here, like here, which is okay. Like, let's say you have a perfect signal. Let's say you understood the market and you're going to buy here and you're going to cash in here, take your profit here, which is great. Okay, let's say that works out for you. But notice the difference between this trade or this trade. Notice the difference in how the market is actually moving. Notice the difference between this trade if you bought here and sold here, or if you sell here and buy here. Like, look at the difference in this. It's quite large. The trend is always your friend. Try always to trade with the trend. If you're having a down trade in the late, like the market that you're watching, doesn't matter which market, it could be cryptocurrency, stocks, forex, etc., oil. Always go with the trend. Notice, study the trend, see how it's going, and always buy and sell with the trend. Now, let's go back into our second most common mistake, which is basically not setting up stop loss. This is a very important one because I see a lot, and I mean a lot of traders actually ignore this one. Not setting up stop loss is basically like gambling. Like, you're just opening a trade and hoping that the market will go with you. It just doesn't make any sense. And that's not even the bigger problem. The bigger problem, I see a lot of traders actually setting up stop loss, but they're setting up in a way that actually doesn't give enough room for the trade to actually activate. So they're setting up too low, and the market actually goes up a little bit, then it catches their stop loss and they lose the trade. But they notice in a few days, if you're trading on a daily scale, that the trade actually reached the take profit that they initially actually put. So let's look at an example here again in the Euro USD. Always try to use different indicators, use different strategy. For example, like if you use resistance and support, like notice here how we are having a strong resistance level. Like after the market went up here, it went back down, then it bounced back up, but it couldn't break this resistance. So let's say you wanted it to open a trade around here. You should always, like, TradingView provides a lot of tools actually to help you with this. So let's say you wanted to go short, okay, around here. So setting up your stop loss like this is a little bit wrong. You should always wait for the confirmation. So let's say you waited and everything went okay. You waited for the confirmation. You started to notice that the market is going down and you wanted to open your trade around here. Okay. So you opened your trade and you set up your profit, like let's say here. Now, how do we calculate the risk like this? Basically, we know this resistance line was holding tight, like the bulls couldn't actually break. So we set up our stop loss just above the resistance line. Basically, just gives you enough room for your trade to breathe. So if the market goes up here, it could hit this resistance line, but most likely it will bounce back down. And this way, you will actually achieve the trade that you have in mind and you will make profit. Let's delete this. Let's delete this. Now you got to understand, TradingView actually offers you a lot of new tools that you can actually use to set up your stop loss. Like, one of the most important indicator that I use is the average true range indicator. It basically tells me how volatile the market is. It shows me how much the market is moving on a daily basis. If I'm using a daily chart, if I'm using a 1 hour chart, it shows me on the 1 hour scale, like etc. It's really important. So let's say, example, I'm going to show you how to use it real quick. Let's say we're going to use the daily real quick. So let's say we want to open a trade right here. Okay, so we notice a downtrend. I want to go short. Basically, I want to sell, and we notice that The market reached here, then it bounced back, but now it's turning bullish, which is okay. But I want to go short, so I set up like my trade like this. Now, where do I set up my stop loss? Now, notice where's the furthest resistance line? We can notice that there is a resistance line around here, where the price actually went up and bounced back down. So we set up our stop loss a little bit above it, okay? And we can measure how much profit we want. Like you can see here, it actually tells you the risk reward ratio is 1.34. Let's say I want to go for 1.5, like this, almost. And we extend our trend like this. Now, if we use the ATR, which is the average true range, it tells us how the market is actually moving. So it moves roughly 471 pips. So this is our stop loss. We're going to set it to double. So 870, that's 140, 942, 942. Notice how where the stop loss actually went. It actually went to the resistance level. So even using the ATR is basically just like you checking the last resistance line. It shows you like this is a safe place where you should put your stop loss at. And that's basically it. You should always put a stop loss and use it wisely because it minimizes your risk and it lets you trade more efficiently. Now let's go back to our presentation and let's talk about the third most common mistake that I see new traders do is actually trading on a large scale. Now what does that basically means? Let's say you opened a new account with your broker. Okay, you actually deposited $1,000. Okay, and you saw like the Euro USD and you wanted to sell. Okay, so you open a trade roughly $200 or $300 worth of trade. Okay, so you put a lot of amount of money on one trade. But the problem here is when the market is really volatile, like every small move in the market could affect your account very large or very large scale. For example, let's talk about Bitcoin. Let's say Bitcoin was at $60,000 right now and you wanted to buy, okay? So you put $300 of your $1,000 on 60,000 and you hope the market will go up and you make profit. So let's say the market actually went down from 60,000 because the Bitcoin market actually moves like a couple of thousand each day. Like it goes up to 67, it goes down to 55. So let's say the market actually dropped all the way from 60,000 to 59,000, which isn't much for the market. But in that small margin that the market moved, you lost all of your money. So this is basically what I mean. You should always trade on a scale according to what your account. I always have a rule that I follow. I always trade from 1 to 10% of my main balance in my account. So every trade I open, it goes between 1% and 10%. So let's say I have $1,000, I trade between $10 and $100. So that's the trade I basically open. Let's say I have $10,000. I open a trade between $100 and $1,000. Basically gives you more enough for your trades to breathe and for your account not to get liquefied. Well, thank you all for watching. I hope you learned here today. Please make sure to like and comment, and I'll see you guys next time.